Hey, this is Current Yield, Grant's Interest Rate Observer of the Air, and I am Jim Grant. And with me is, for a change, is Evan Lorenz, the great deputy editor of Grant's, and also, actually not for a change, Evan is and I actually are inseparable, except after work, right? And Henry French here is our sound engineer, and we are joined today by John D. Spears, who's one of the preeminent value investors. And we're going to hear all about John and his career and about the art and science of buying low and selling high in just a moment. But Evan, we have news. I expect it might not be such hot news by the time our voices are heard, but I understand the Fed has arrived at a decision today. We're talking on Wednesday, June, what is it? June
14th?
Oh, yeah, all day.
The Ides of June?
Okay, so what'd they say?
Nothing, but apparently they said it hawkishly. They stood still, did not raise rates, but I've been told that it's a hawkish pause.
Oh, so like watch your step?
I actually think Jay Powell, when he got up to the presser, did caw like a hawk.
All right, so we are stuck with a funds rate of what, 5 something, right?
Yeah.
Okay, well, I knew sooner or later they would do nothing, and today is the day. Let me see. So, John, you are with us for the first time, I think.
Indeed, yes. Yeah. Yes, and this is probably the first time with this kind of technology and procedure.
Well, this is
I've done Zoom calls and things, but
that is nothing like Zoom. We don't go in for Zoom around here. This is a pure voice, which gives free play to the imagination and to the ears.
Wonderful.
Yeah.
So I'm not being photographed.
No. So it's like listening to a ball game on the radio. You can see it in your mind's eye much more vividly than the television cameras can project.
Yes, indeed.
Okay. So, John, to introduce you somewhat cursorily, was a Chicagoan, born in 1948, which leads me to say, John, that you have a little bit less experience in this business than some people around this table, but I'll let that pass for now. And
you look 25 to me, Jim.
Why, thank you. You can stay for dinner too, John. Thank you. And John is by trade and by, I think, temperament, the species and genus of value investor.
I wouldn't say a genius, but I'm certainly a student
that was a Freudian slip, which was purely intentional. So, John, you worked for many years for the firm of Tweedy, Browne, and you began your investment career at the age of, 4 or 5 months? I think you said you were in your bio.
That's right. There was a Graham Dodd and Coddle was under my pillow.
Yeah.
No.
And here we are, some years later. I wanted to invite you to tell us about your arrival at Tweedy, Browne. You can skip the business about pulling crabgrass for 50 cents an hour and for investing in Allside Corporation when you were a mere teenager.
Amazing.
Yeah.
Amazing.
But tell us, if you would please, about the year 1974 and your arrival at Tweedy, Browne as a not quite 30-year-old aspiring investor in cheap stocks.
There was a gentleman who's passed away by the name of Bill Browne, one of the founders of Browne, Kniff, and Goldfarb. And I was working as a sort of a junior investment analyst for William Kent, who was partners with a firm in London by the name of the name's escaping me, but he was also partners with Bill Berger out in Denver, and Robert Fleming and Company in London. And I was doing work on advertising stocks. Bill was an expert on that, and he was interested in me, maybe because of my youth, and said, "What do you do with your own money?" And I mentioned that I had this investment partnership, John Spears Associates, that might have had a few $100,000 in it at the time, and that I bought these undervalued stocks, typically companies selling below net working capital, often with cash equal to more than the stock price. And he said, "You should meet the people at Tweedy, Browne." Oh my goodness, I see them in the pink sheets all the time. I think we're interested in the same stocks. So he introduced me to Ed Anderson. Ed and I went out to lunch, and they decided that, at that time, I had a side business also finding takeover candidates for the wheeler dealers of the time, such as Ron Perlman or Arthur Cohen, a number of different people that were in the newspaper quite a bit, buying and selling companies. So I would do research on companies and find companies that could be taken over, where the shareholders, the insiders, owned less than typically less than 20% of the outstanding shares. So I would describe a company as Company A, Company B, Company C, and I would send these out to these active takeover type people. And if they were interested, I'd have a meeting with them. I explained my fee structure. If you buy any shares, you pay me, I think it was 5, 4, 3, 2, 1, 5% of the first million, each additional million. And I made more money doing that than I'd ever made before. These commissions, Ron Perlman did a takeover that paid me well. And I think Tweedy thought that they could take me on board and not have to pay me that much because I'd bring in this takeover business. And I had also been I'd been using them as my broker.
Okay.
After
now, I would like to help the audience understand the state of things in the year 1974, because it as if it all happened on a exoplanet of some kind. And the way to do this, I think, is to recall a speech that Benjamin Graham, so-called father of value investing, gave in 1974 to New York Society of Security Analysts, some professional body. All right, and the title of this thing was Renaissance for Value. That was the way Barron's later published the text of his talk. And one of the highlights of this speech was Graham saying that there are 100 stocks, mostly listed in New York Stock Exchange. They're trading for less than net current assets. I think he said less than working capital, which means that as they put it, as we put it, we Japan bulls in the late 19th, that the business is free and you are buying it at a discount of cash, net cash. 100 of these babies. And Graham said to the assembled analysts, he said, I think I've got the text of this thing here. Oh, yes, that he and his partnership, that was Graham Newman, was his partnership. And he said that we have been, he called them the sub-asset stocks. And he said that we've been making rather a specialty of this, buying stocks for less than the net cash. And we decided that it's a very good thing. He said that your downside's rather protected. And he went on to say, well, it might be a little risky in doing only that. So this was the state of things in 1974. Wall Street was flat on its back. And this audience, you could tell by Graham's remark, was rather skeptical of his business about buying stocks at less than net cash. They said a lot of people lost money doing this recently. And Graham at one point says the following. He said, quote, "You are now hearing some of the old-time religion. You may not be converted, but it shouldn't do you any harm."
He was such a great writer.
Oh, God. Well, Graham was one of the best educated people ever on Wall Street. He got a classical education in, of all things, New York City public schools. And Graham contributed at the age of 17 an essay on how to improve the teaching of calculus to a professional mathematics journal when he was still in high school.
Amazing.
That's Benjamin Graham. Okay,
amazing. Yeah.
Okay, so I'm a little too windy about this. So this was Wall Street. It was, in retrospect, John D. Spears, this was the moment. And you were the man. You walked into Tweedy Browne when they were giving away stocks. It was like it was raining soup, and only you guys had spoons. Everyone was out there with a fork.
Exactly. The Nifty 50 was starting to fall apart in 1974, as I recall. The stocks at over 100 times earnings, and like Avon.
But what was it like?
Well, you'd buy I remember a company called Safe Flight Instrument, which had about $5 in net cash. I don't know, it had something like an 80-to-1 current ratio, no debt. And we thought it was a great deal at 3, and then we'd buy more at $2.50.
I know how that works.
Got down to as low as $1.50, so it had $5 a share in net cash.
Did you lose heart on the way down?
Well, no, we had so many different issues. I think we probably had about 500 issues in the Tweedy Browne portfolio.
Well, why not a greater concentration given the self-evident, compelling, can't lose value proposition in some of these names? Why the diversification?
I think just a risk-averse actuarial approach, a sort of a statistical way of thinking about that maybe some of them won't work out. Maybe managements will take the cash and blow it on an overpriced acquisition or something like that. So So that's how
Okay,
I did it.
So this is the way you began your. You had a lot of experience, as you indicated before, in investing. You had 2 years in a self-directed course of study in finance and accounting that took you to advanced accounting. So you got an early start in your professional career, but still, it was sensibly the beginning of your life on Wall Street this year, 1974. And I'm going to present this proposition to you, John D. Spears, Dean of Value Investing on Wall Street, that your career has been has been downhill since the time you walked in the door of Tweedy, Browne, given, if we define it as a set of opportunities available to a value investor. It's been downhill since you started. Comment, please.
Well, what came to mind was the first time I ever met Warren Buffett was when he came into the office at Tweedy, Browne. And as I'm sure you know, we were the primary broker, maybe not the only broker that accumulated his shares at Berkshire Hathaway. And Buffett's so funny. He said, like Ed Anderson said, you meet John Spears. He's joined us as an investment analyst, and he works on takeover candidates and that kind of thing. And Buffett said, well, you've peaked. You're at the right firm.
Exactly.
You're at the right firm. It can't get any better, So yeah, the luck of good timing. It's amazing.
Well,
yeah,
self-made luck. So let us not dwell overly on what some listeners might view as a nostalgic and rather self-indulgent tour of yesteryear. If we have to,
let's leave that. Yeah.
If we got to, let's get down to the present. Okay, so I'm going to skip a few decades, and here we are. What's the year, Evan? 2000 something?
23, I think.
Already?
A love of the past.
All right. So 2023 already. So let us say that the year 2023 bears slight resemblance to 1974 in the set of opportunities that the investor confronts. And two questions. Have you changed, as if one could change one's temperament, but in what ways have you adapted, as investors must adapt, to a new world? Let's start with that one. The world is inverted in some ways. New valuations seem not to matter. People disparage book value as an obsolete measure of value, tangible, intangible assets of the thing, et cetera, et cetera. There's a stock, is there not, Evan, called NVIDIA?
I think there's only a stock called NVIDIA right now. Right, it only goes up.
It's the one stock, right?
Yeah.
Okay, but in this one stock is trading at, I think, 48 times?
I think over 40 times sales.
What do you mean sale? It can't be.
That's revenue, the top line.
Yeah.
If you assume the company has no expenses, then that is also the earnings, but that is sales.
Yeah, actually, that datum did appear in grants recently.
All the expenses are extraordinary. You just...
One side note, when we wrote about it, it was 38 times sales, and the stock has rallied since.
Yeah. Okay. So how do you adapt?
I'd say that it does go back to Graham. Graham often talked in security analysis about the value to another business or to a private owner of a whole company, a family that owns it. So I think that was the basic idea for our evolution when net current assets disappeared, toward looking at comparables, toward looking at acquisitions that had actually occurred, looking at various investment banking type ratios, enterprise value to sales compared to what companies have gone for in the same industry, enterprise value to EBITDA.
So you're talking now about relative value compared to the absolute bedrock, absolute values prevailing when you started.
Well, if you define absolute value as takeover value. I mean,
I'm talking about net cash.
Net cash. Oh, we went way beyond that. Yes. I think the first stock was the Crand company, Binney and Smith. It was selling at book value at about 5 times earnings. So it was earning a 20% return on equity.
Okay, so that's over. But now you are comfortable, are you not, in looking at relative values and not insisting on book value, some such thing, or 5 or 8 times earnings. You are prepared to pay 18 times earnings, let us say, if that is where the market is pricing other relative comparable things.
I'd say today 18 times would generally be pretty rich valuation for us, but definitely most of our stocks are earnings flow type valuation.
Now, what does that mean, earnings flow?
Well, they're related to EBIT and
I see. As opposed to balance sheet.
As opposed to balance sheet. Well, now we still do some balance sheet ones. We bought shares of Jeffries within the last few years, when it was about, 60% of tangible book. And insider buying was happening.
In addition to looking for value in the 50 states, you also invest abroad. Are you finding more opportunities outside of the U.S. or inside the U.S.? How does the value landscape look on a global basis?
Well, we're not looking at, we're only looking at sort of mostly the bottom layers. And we're also getting a lot of clues from insider buying. So, we have computer screens that would, for example, rank all companies on enterprise value to EBIT. And we tend to be in the lower deciles.
John, I heard you say something that I haven't heard in a while. It's rather refreshing. In fact, it sounds melodious, and that is EBIT. You didn't say EBITDA.
Well, we look at both because investment bankers look at they tend to never look at EBIT.
Right.
It seems like it's always EBITDA. Everything's EBITDA.
Yeah.
But no, depreciation is real. Companies do spend money and replace. Yeah, exactly. I'm certainly a depreciating asset.
A friend of mine, a late
you
friend.
You have more runway than I do.
Well, late friend of mine, Michael Harkins, in 1987 or so, said, "Have you noticed that the people who most talk about EBITDA are the guys who have second and third wives?"
Okay. You started your career with an advanced study of accounting. How do you feel with accounting being so corrupted over the last 2 or 3 decades? When EBITDA was first kind of pushed by the John Malones and the TCIs of the world, it meant just earnings before interest, taxes, and depreciation. Now it also means before the expenses we'd prefer you not to look at, also adding back in the cost savings we expect to get sometime in the future. Also, it seems like numbers getting weaker and squishier over time.
Well, we try to deal with that judgmentally. Think about it. Yeah, we look in many instances very, very carefully. Not in all instances. We still do some things that are more statistical and just take a diversified bet.
What's Tweedy Browne's approach to momentum? I suppose you're big into momentum.
It's a fact. You mean in our case, reverse momentum? In many, many instances, the stocks that we're interested in, if you look at the chart, there's been a considerable recent decline.
Well, this raises the question of temperament and of conviction and the like. So, all sorts of bad jokes on Wall Street about trade averaging down, right? You've heard them all. Friends of mine who have made their lives in what is still called value investing say that they actually, they relish this, they contend. I'm not sure the degree of sincerity is in that contention, but they say if you know the situation well enough, you are more than happy to get a better price on the way down. You don't buy everything at the first price. Tell us about your approach to that and about how you manage the emotions that might be attendant upon watching your object of affection deteriorate in the eyes of the world and on the screen in front of you.
Well, unlike some, we don't love it.
Thank you, John D. Spears. That's a refreshing confession.
It causes emotional pain in my case, but I think that the pain is eased by the broad diversification. As typically as things that you bought tank, there's usually bad news. So there's often a reassessment. Have the facts changed sufficiently that we want to continue?
How often do you choose not to?
I don't have any data on that. I just don't. I don't know.
Sometimes,
but sometimes, yeah, and other opportunities. There's a stock we've gone into recently in a very diversified way. Paramount Global, which owns all the media assets, CBS TV, and they're getting into streaming and they're losing buckets of money on it. And we first became interested when Sherry Redstone, the chairwoman, daughter of Sumner Redstone, bought several $1 million worth of stock at 37. Now it's 15. She bought some more. We bought some more. I think the premise still holds. If you subtract out the losses from the streaming business, the old legacy assets are still earning EBIT of about $7 a share, EBITDA of around $8, and there's some debt, but it's got some potential. I don't think she'd be buying a few $1 million more stock at 15 if she didn't think.
She's probably buying because Tweedy Browne's buying.
Oh, yeah, she called us.
That would be embarrassing, wouldn't it?
No, because Berkshire Hathaway's bought a lot of it. They're the number one shareholder, I think, besides her.
What are your clients say? I mean, it's no front page news that value investing is not the thing, as it might have been years ago.
It's the bad thing.
Well, I didn't. I didn't want to say it that way, John. Well, I was
saying that's not the S&P 500.
I was being interviewed, as I sometimes infrequently am, and said in response to my expression of interest in some value-related thing, she said, "I've been hearing that for years. God, I don't want to hear that anymore." And I might have taken that as a sign of a bottom in the very idea of buying cheap securities, but no, they get cheaper and so what I guess what an extraterrestrial visitor might ask in its innocence is, what's wrong with looking for bargains? John, I have to know.
What's wrong? There's nothing wrong with looking for bargains. There's but unfortunately, we've had a very bad period, as you well know. It's been a rough time versus index funds.
Well, how do you suppose that the growth of semi-automatic or purely autonomous investing techniques, bot and computer-driven program, how has this affected the very premise of value investing, which is the appraisal of individual situations, looking for value? If investing has turned into a robotic hunt for momentum and other such so-called, what do they call factors?
Yeah, factor investing, momentum.
Yeah. Is there some point at which the sheer, visible, undeniable appeal of a cheap security is going to, on its own, force a reversion to what might be called common sense? Or is this, what's going to take to, John, help me?
Well, good performance is always going to attract.
Right.
And
so just change it.
And people are looking, of course, at relative performance, and it's become even more that way.
Yeah. Well, Buffett, if you would please help us interpret for us the evolution of Warren Buffett's thinking. When he walked in the door at 1974 with Browne, he might have been one kind of investor. He has turned in to rather a more eclectic one, I would say. Certainly one who was less. I'm not sure he was ever dogmatic, but certainly one who was rather more inclined to veer constructively from the protocols and doctrines of value investing as it's codified in this hefty volume security analysis. So how is that? What's he done, and what might one learn from that?
We all have been great big students of Warren Buffett, and I think of the value to a private owner. That idea, which is in security analysis, is certainly key to him. And Charlie Munger introduced Warren to a lot of interesting ideas about growth, the value of growth, the value of distributable cash flow, high return on tangible net assets. So if you earn 100% on tangible net assets, and your ratio of tangible net assets to sales is 10%, most of your cash flow is going to be distributable. You'll be able to use it to buy something else. And he thought that was pretty neat, and continued with that idea, the high return on capital companies. But of course, it's hard to put Warren Buffett in any kind of a total box. I mean, he was selling oil companies a few years ago. Now he's bought them.
Japan strikes me as a case study in ideas whose time never seemed to come until at last they arrive. The late Alex Porter and I started something called Nippon Partners, along with Ken Shirley, in 1998, when Japan was selling for, it seemed, nothing. And we built portfolios around and of companies selling for less than net current assets. And
I did some of that myself also, but maybe at an even bigger discount.
They remained, many of them, at just that level of compelling valuation for many, many years. More recently, it seems that Japan has rather caught on. Certainly, the Berkshire Hathaway people have taken a cotton to it. Is Japan figuring in your overseas investing?
Yes, it is. Yeah. We bought a number of stocks there.
Yeah.
More. I mean, a lot of them have been below tangible book value with big net cash positions.
Yeah.
But the earnings component has been also important. So maybe valuing a company at 10 times EBIT.
Yeah.
And then adding in the cash.
Any other countries that might be surprising either to the upside or the downside that you see in your international investigation?
Well, we're primarily in developed markets, and the screening is across the board. We come across things all over the place.
Yeah.
I mean, we've been all over the place.
How do you think about the valuation cycles in the U.S.? So you started your career just at the end of the junk market in the 1960s when valuations were high. Valuations came to absolute low levels in the 70s and early 80s. AQR recently came out with a paper saying that if you look at the U.S. market, yes, it has outperformed all of its global peers over the last 30 years, but the majority of that outperformance has just been because the U.S. multiples have gone up, and now the U.S. market looks expensive relative to the rest of the world. How do you think about these kind of large valuation cycles, and how do you play them as both an investor inside the U.S. and somebody who can allocate outside?
I would say we don't look at it that broadly. We don't overthink it. Maybe we're just we're kind of plowing away, looking at the conveyor belt of things coming across our attention, and we're focusing on things that are more intriguing on a first cut basis based on factors, on numbers, and low enterprise value to EBIT, low PE ratio, high earnings yield. So in a way, that's sort of another way that we think about it. We call it owner's earnings yield. So if we bought the whole company at this price, what kind of a yield would we get? So that gets down to earnings yield. It gets down to also the cash flow that can be put in your pocket rather than reinvested because the business has gone up, and for every 10% increase in sales, you got to have half that go into additional investment in the business.
How many different names in your various portfolios, John?
Well, over 100, I think. I'm not sure what the total is right now in the International Value Fund, but it might be approaching, 140 maybe.
How do you keep up?
But I don't keep. Bob Wyckoff is better at answering those questions.
How do you or they or your confreres keep up with that many names?
Well, I think that there's some orientation probably toward sensibly being more in tune with quarterly information for our larger holdings than smaller positions. Kind of keeping an eye on the news flow about the company. But I'm not. People do it. I'm not that involved with that right now.
Has Tweedy Browne or you ever bought or sold a share based upon any macroeconomic datum?
Never. No. I mean, that's background music. We read the newspaper, but no, not. It's always been on value to a private owner concept or owner earnings yield.
Yeah, stock by stock.
Yeah, what's available? What would be the best opportunities given our screening?
Yeah.
What would give us the best owner's yield? What's the biggest discount from an estimated private market value?
We have lived through, perhaps we have seen the end of the great bull bond market that began in, I guess, October 1981 and has taken yields in the long end of the Treasury curve from 15% to like nothing, and now it's a little bit more than nothing. How do bonds figure into what you do? Ever bought one? Anticipate fixed income investing?
Well, I have a fair amount of cash personally, and I've been buying the short-term T-bills, but that's about it.
You said you wouldn't give us a tip, and here you have.
But it's not.
What's the ticker on that?
They would get 4 points, 4.8,
yeah,
5%.
What's wrong with that?
Yeah, not bad. But of course.
So you don't have all your money in Tweedy Browne stocks?
No, not all. No.
I didn't mean to pry, John.
No, that's okay. I've always had a lot of cash. We have to, because of taxes, I tend to got a lot of money in the various Tweedy Browne mutual funds and other entities, but I also have individual securities that are often the same stocks that are owned by the portfolios, and I have to get all kinds of approvals to do that. And so as a result, over the years, cash is sort of built up.
Yeah, okay. That's what we call in Brooklyn. We call it a high-grade problem.
Obviously, after taxes and inflation, it's
yeah, but still, you
it's lousy.
Yeah, but still, it's not. Wouldn't use it in the incinerator.
No.
Okay.
You need to sleep well when in bad markets, and you feel envious in good markets.
So you say you don't look for opportunities based off what's happening in the macro or what's the overall valuation of the market, but just what your screens produce, the conveyor belt.
Exactly.
What's the throughput of the conveyor belt today, and how does it look relative to other, junctions in history? Like, are you seeing a lot of ideas come across that potentially are Tweedy Browne worthy, or?
Yes. I'd say the flow has been pretty good, and I think it seems just from reading and occasional looking at screens that it's a bit of a two-tier market in the United States, that a lot of stocks are going down, and we get a lot of ideas again by insider buying tips.
So the new low list and heavy insider buying.
Those are good places to look.
Okay.
We'll be there.
John D. Spears, thank you for being with us. What fun.
Well, thank you for the opportunity. Thank you for the great questions.
I think for a man of so little experience, you've done very well. Henry French, thank you. Good sound. Evan, nice to see you. And ladies and gentlemen, thank you for listening. This is Jim Grant on behalf of Current Yield, Grant's Interest Rate Observer of the Air.